Somewhere between fear and greed, there is a moment almost nobody notices. It doesn't look exciting. It doesn't trend on social media. Nobody screenshots it and posts it with rocket emojis. It just sits there quietly, while two of the most respected macro minds in the world point at the same calendar and say the exact same thing in two completely different languages of finance. Raoul Pal and Tom Lee. Different careers, different frameworks, different ways of reading markets. One built his reputation inside Goldman Sachs and hedge funds, obsessing over global money flows. The other built his reputation as a Wall Street strategist, obsessing over market structure and where the next wave of buyers will come from. And yet, right now in the middle of 2026, after a brutal year that shook out almost everyone who wasn't paying close attention, they are both circling the same conclusion. The bottom may already be behind us, but the real move, the one people will still be talking about years from now, hasn't even started yet. And what's strange is that most people watching this market right now are looking in exactly the wrong direction. They're staring at yesterday's candle. They're refreshing price charts every 10 minutes. Meanwhile, the actual signal both of these men are watching is happening somewhere else entirely, quietly, in the plumbing of the global financial system. By the end of this video, you'll understand exactly what that signal is, why it matters, and what specific window of time both of them are watching closely right now. Before we go further, quick disclaimer. This video is for informational and educational purposes only. Nothing here is financial advice. Bitcoin and crypto assets are extremely volatile, and you should always do your own research or speak with a licensed advisor before making any investment decision. We're simply breaking down what two well-known investors are publicly saying, so you can form your own view. Now, if you're new here, welcome to the Wealth Continuum, where we break down the biggest money movements before most people even notice them happening. And if that sounds like something you want in your corner, you know what to do. All right, let's get into it. By the way, before we dive in, tell me something. What are you doing while watching this video right now? Are you on your lunch break, lying in bed scrolling, or sitting at your desk pretending to work? Drop it in the comments. I actually read them. Let's start with the obvious question. If the bottom really is in, why doesn't it feel that way? Because historically, bottoms never feel bullish while they're happening. They feel confusing. They feel exhausting. They make even experienced investors question everything they believed a few months earlier. And that's precisely what this year has felt like. Bitcoin has spent much of 2026 frustrating both bulls and bears at the same time. Every attempted breakout gets sold into. Every sharp dip gets bought right back up. Every narrative seems to collapse within days of forming. As of the 1st of July, Bitcoin is trading somewhere in the high $50,000 range, a steep distance from the all-time high above $126,000 it touched back in October of last year. That's not a small drop. That's nearly half the value of the asset wiped away in a matter of months. That's a market that has tested the patience of even the most seasoned investors, the kind of drawdown that makes people question whether the entire thesis was wrong from the start. Fear and greed indexes have been sitting deep in extreme fear territory for weeks. Major public companies that once proudly stacked Bitcoin on their balance sheets have quietly been trimming their holdings. Some mining companies have been selling coins just to fund pivots into artificial intelligence infrastructure instead. On the surface, everything about this looks like a market that lost its story completely. But here's the part almost nobody talks about. Tom Lee isn't simply calling for higher prices out of habit. He's arguing something much bigger. He believes Bitcoin has been showing behavior that historically shows up near the beginning of bull markets, not the end of them. According to Lee, the technical structure and the pattern of institutional buying suggest this is a transition phase, not a market falling apart. Stay with me here, because this next part is where the story actually gets interesting. Tom Lee isn't just saying buy the dip like 100 other voices on your timeline. He's arguing that the entire structure of Bitcoin's 4-year cycle may be quietly breaking apart and turning into something new. And if he's right, the implications are enormous. So here's a question worth sitting with for a second. What if the thing that scared you out of this market wasn't the end of the story, but the middle of it? Hold that thought, because that's exactly where Raoul Pal enters the picture. Raoul Pal has spent years repeating one single idea, almost to the point of sounding like a broken record. Not inflation, not politics, not halving dates, liquidity. According to Pal, global liquidity explains the overwhelming majority of Bitcoin's biggest moves. He has said the correlation between Bitcoin and global liquidity has remained remarkably strong, sitting somewhere between 85 and 90% depending on the model you use. He argues Bitcoin tracks the expansion and contraction of the global money supply far more closely than most investors ever realize. Think about that for a second. Most investors spend their entire day obsessing over ETF flow headlines, Federal Reserve speeches, election drama, and regulatory noise. Meanwhile, Pal keeps his eyes fixed on one single variable. How much new money is entering the global financial system? Because when liquidity expands, risk assets tend to rise together. Stocks rise, technology rises, crypto rises, and historically, Bitcoin often rises the fastest of all of them. Pal has gone even further than that. He has said liquidity accounts for roughly 90% of the movement in Bitcoin's price and something close to 96% of the movement in high-growth technology stocks. Think about how bold that claim really is. He's essentially saying that earnings reports, product launches, and even most of the news headlines you read every day matter far less than most investors assume. The money supply is doing almost all of the heavy lifting. Now here's where it gets interesting. Powell believes the slowdown we've lived through this year isn't proof that the bull market failed. He calls it a liquidity lag, a delay caused by the United States Treasury rebuilding its cash account, the draining of the reverse repo facility, and ongoing quantitative tightening working through the system at the same time. Not an ending, a pause, and according to Powell, that pause may be closer to finishing than most people assume. He has pointed to Bitcoin trading roughly 1.5 standard deviations below its long-term fair value trend, a zone that historically marked strong accumulation phases back in 2015, 2018, and 2022. Every single one of those earlier periods felt awful while they were happening. Nobody rang a bell at the bottom. Nobody sent out a press release. The people who did well during those windows were simply the ones who kept paying attention while everyone else looked away. Here's a question worth pausing on for a second. If Pal is right that this exact same pattern is playing out again right now, would you even recognize it while it's happening? Or would it just feel like more of the same frustrating chop that's been grinding on your patience for months? But stay with me, because before we get to the date both men are watching, there's one more piece of this puzzle. And it's the piece Tom Lee thinks almost everybody is underestimating. Every major Bitcoin cycle in history had one dominant type of buyer driving it forward. Back in 2013, it was retail enthusiasm. In 2017, it was ICO speculation running wild. In 2021, it was institutions discovering Bitcoin for the very first time. So here's the real question. Who drives the next leg of this cycle? Tom Lee believes an entirely new category of buyer is emerging, one that doesn't look like any of the previous ones. Not pure retail speculation, not just hedge funds chasing momentum, entire pieces of financial infrastructure, stablecoin networks processing real payment volume, tokenization platforms, banks quietly exploring blockchain rails, corporate treasury companies building balance sheets around digital assets. Lee has pointed to Tether as one example of just how profitable blockchain native finance has become, noting the company runs with a fraction of the staff of a traditional bank while generating billions in annual earnings, all while employing just a few hundred people compared to the hundreds of thousands employed by legacy banking giants. That's not a speculative narrative. That's operational proof that the technology already works at scale, quietly, in the background, while most people are busy arguing about price charts. This matters more than it might sound like at first. But here's what they're not telling you on most other finance channels. This shift isn't loud. There's no single headline moment where this becomes obvious. It shows up slowly in balance sheets and payment volumes and the kind of institutional plumbing that never trends on social media, which is exactly why most retail investors miss it completely until it's already priced in. Because it changes the entire character of the market. Instead of explosive retail bubbles followed by brutal crashes, you potentially get something different. Persistent demand, slow, steady accumulation, longer cycles, bigger and stickier pools of capital. This is exactly why Lee has repeatedly suggested that Bitcoin's traditional 4-year rhythm might be stretching into something longer. Now compare that to Pal's view for a second. Pal sees artificial intelligence spending, tokenization, digital asset adoption, and global liquidity all converging into something much bigger than a typical crypto cycle. He has gone as far as extending his own framework from a 4-year cycle to a 5-year cycle, tying it to how global government debt maturities have lengthened since 2021 and 2022. Two completely different paths of reasoning, same destination. Here's what I want you to think about while we move into the next part. If both of these men are wrong about timing but right about direction, what does that actually mean for someone sitting on the sidelines right now? Hold that question. It matters more than you think. This is where the story gets genuinely fascinating. Neither Pal nor Lee is claiming Bitcoin explodes higher tomorrow morning. In fact, both of them have been unusually careful about timing this year, especially after some earlier calls didn't play out the way they expected. Tom Lee has repeatedly framed 2026 as a year of two distinct halves. He warned that the first half would likely be rough, filled with institutional repositioning and what he called a strategic reset across crypto markets. But he has continued to argue that this volatility is exactly what sets up a much stronger second half of the year, one where he still expects Bitcoin to reach new highs, with a long-standing target around $250,000. Raoul Pal has pointed to a similar window. His 5-year supercycle framework originally pointed toward the second quarter of this year as a potential turning point, tied directly to global liquidity indicators starting to expand again after the earlier drought. Now, here's what's important, and honestly, this is the part most crypto content creators conveniently leave out. Some of those earlier mid-year targets didn't fully play out the way either man initially framed them. Bitcoin was still consolidating well below prior highs heading into the back half of the year. Pal's original call for a peak near the second quarter came and went without the explosive move he described. That's a miss, plain and simple, and we're not going to pretend otherwise here. But here's the thing about macro theses built around liquidity cycles. They rarely move on a clean, predictable schedule. Pal himself has acknowledged that liquidity takes time to work through the system before it actually shows up in asset prices. A miss on timing isn't automatically a miss on direction. And that distinction is exactly why this next stretch matters so much. Not because Bitcoin has to moon immediately, but because this is the window where their entire thesis either starts proving itself or starts quietly falling apart in front of everyone. This is where sophisticated investors stop watching today's candle and start watching the broader trend underneath it. Not the next headline, not the next inflation print. The liquidity trend building underneath the surface. Because if liquidity genuinely turns higher through the second half of the year, history suggests Bitcoin usually follows, sometimes with a lag of several months. This is where it gets really concerning for anyone trying to time this perfectly. Because if the lag really does stretch several months, the confirmation everyone is waiting for might not arrive until Bitcoin has already moved a significant distance away from where it's trading today. By the time it feels safe, it might not be cheap anymore. Quick question for you, and I actually want you to answer this one honestly in the comments. Are you someone who waits for total certainty before making a move? Or are you someone who positions early and accepts the uncertainty? There's no wrong answer here. I'm genuinely curious which type of investor is watching this video. Now, here's the uncomfortable part. The part most bullish content conveniently skips. What happens if they're simply wrong? Because every confident bull market thesis sounds completely convincing right up until the moment it doesn't. The biggest risk here isn't really Bitcoin itself, it's liquidity. If economic conditions deteriorate faster than expected, if capital tightens instead of loosening, if investors broadly retreat from risk assets across the board, then the entire bullish framework both men are building weakens significantly. This is exactly why even Tom Lee, despite his long-standing bullish stance, has repeatedly warned investors to expect real turbulence, describing potential drawdowns in broader markets that could reach 10, 15, or even 20% before any recovery takes hold. And Pal has been just as clear that liquidity doesn't move in a straight line. He has pointed to 2027 as a period where the next liquidity downturn could eventually arrive, meaning the current window isn't a permanent green light. It's a specific phase with a shelf life. There's also a structural wound still healing underneath all of this. Back in October, the crypto market suffered what many are calling the single largest deleveraging event in its history, wiping out roughly $500 billion in value within days and breaking the normal linkage between Bitcoin and other assets like gold. Pal has argued this event damaged market plumbing itself, not just prices, temporarily removing market makers and liquidity providers exactly when they were needed most. That kind of structural damage doesn't repair itself overnight. It takes time, patience, and rebuilt trust before capital flows normally again. This is where serious investors separate themselves from gamblers. Serious investors don't ask, will Bitcoin go up tomorrow? They ask a completely different question. Is the underlying trend actually strengthening, or am I just hoping it is because I want it to be true? And right now, that's the real debate playing out among people who actually study this market closely. Not whether Bitcoin survives as an asset class, but whether the next expansion phase is already quietly beginning beneath all the noise. Stay with me, because we're about to bring all of this together, and I think the conclusion is going to surprise a few of you. So let's put everything together. Tom Lee believes the market has likely already established its bottom, and that Bitcoin's traditional cycle structure is evolving because of genuine institutional demand and entirely new forms of blockchain adoption showing up in the real economy. Raoul Pal believes global liquidity remains the master variable behind almost every major move Bitcoin makes, and that an eventual expansion in that liquidity could unlock the next phase of this entire cycle. Different reasoning, same destination. The bottom, in their view, may not even be the interesting story anymore. The real story is what happens next. Because if they're right, the investors who are waiting for absolute certainty before acting may eventually get exactly what they're asking for, confirmation. But confirmation almost always arrives at a much higher price than where the opportunity actually existed. And if history has taught serious investors anything, it's that markets rarely reward people for waiting until an opportunity becomes completely obvious to everyone at once. So here's the real question I want to leave you with today. Are Raoul Pal and Tom Lee genuinely seeing the early stages of Bitcoin's next major expansion phase? Or are two brilliant, experienced investors falling into the exact same trap that eventually catches every market bull sooner or later? I genuinely want to know what you think. Comment below if you believe the bottom is truly in. Hit, like if this breakdown actually helped you understand what these two are really saying, instead of just the headlines. And if you want more videos like this one, breaking down what the smartest money is quietly doing before it becomes obvious, subscribe to the Wealth Continuum, because that's exactly what we do here every single week. One last thing before you go. How's the weather where you're watching this from? I'm always curious where this audience is tuning in from around the world. Drop your city or country below. Let's see how far this actually travels. And if this video gave you even one new way of thinking about where this market might be heading, do me a favor and share it with one person who needs to see it. Someone who's been sitting on the sidelines, confused, waiting for a sign, because the biggest shifts in wealth are almost never obvious while they're happening. They only look obvious in hindsight. See you in the next one.